So just to provide some quick background and context to this presentation, those of you who attended the very excellent version of this event last year in Nigeria will remember that the theme was in fact liquidity and enhancing liquidity. And so the idea was that we would kind of close out that session with a recap of many of the major themes that were discussed at that conference in great detail, and then lead us into what we're focused on today. This report was actually produced as an output of the Emerging Markets Working Group within the WFE. So the WFE is an industry organization with over 200 market infrastructures, exchanges, and post-trade infrastructures represented. The combined market capitalization of the companies listed on those exchanges is, I think, now over 70 trillion US dollars. We have nearly 50,000 listed companies represented. And our membership spans some of the largest exchanges in the world, as well as some of the more emerging market exchanges. The Emerging Markets Working Group is a critical working group within the WFE. And this report that we produced in conjunction with Oliver Wyman was actually driven by the membership within the WFE, who expressed an interest in getting a better understanding of how to enhance liquidity within their markets. The group was ably led by the Philippine Stock Exchange, the Stock Exchange of Mauritius, and the Egyptian Exchange. And whilst personally, Quintin and I can tell you it was sometimes painful having to deal with multiple stakeholders pushing us harder to refine the report, include other elements, bring in more case studies, we think we've ended up with a much better report as a consequence of that. So I'm going to hand over to Quintin to present, I think, some of the sort of key theoretical aspects that have emerged from the report that we did, and we'll kind of mutt and jeff it as we go along.
Perfect. Thanks very much, Yvonne. So I'm Quintin Gollard, part of Oliver Wyman. We're a global management consultancy firm, and we were delighted to be invited by the World Federation of Exchanges to obviously co-author the report. And as Yvonne said, there were many late nights kind of iterating back and forth between the two of us. But I think where we ended up was a fascinating report. And I think one of my favorite things in the report is the number of case studies in there that very kindly were sort of provided by the membership of the WFE, and really highlight some areas where exchanges have done a fantastic job in terms of implementing some of the levers and recommendations that we go through in the report. I mean, I think I'll flick onto some of the just sort of key attributes about liquidity, and I'm sure there'll be sort of no surprises for the people in the room just how important liquidity is to emerging market venues in terms of helping build and structure those markets. And we really see it as a sort of cyclical benefit in terms of those markets. You know, as liquid markets, it becomes much easier for firms to list and raise capital. There's a lower cost of equity for them. They can begin to raise more capital and make more productive investments. And they begin to generate a much higher return on that invested capital as well. And that obviously has a tie back to the investors in terms of that market as well. They're able to actually visualize and see those higher returns on the investments they're making in the stock market. They accumulate greater capital and they've got more equity there to reinvest. And that becomes a sort of self-fulfilling circle in terms of the benefits of liquidity. Obviously, there's lots of things that can go wrong in that cycle, and I think the report tries to address kind of where things can break down in that cycle. And as you've heard before in this conference, you know, liquidity is somewhat elusive. There's no golden bullet that will provide liquidity. It's a multifaceted aspect, but the benefits, if you get it right, are phenomenal. I've gone one slide too far. Either way, I will stop here and sort of talk about the three sort of buckets that we talk about in the report, and this is sort of where we get into some of the detail. I think during the report there's so many different ways you can think about enhancing liquidity and growing liquidity. We took sort of three lenses to the problem and began to sort of break it down. And I think that the first one that we really go into depth is really talking about how you increase and diversify that investor base. And true liquidity can only come from having a genuine diversity in that investor base. And that can include sort of a range of sources. You know, in many markets, they've focused on the retail aspect of it. Even in developed markets, there's still several blockages to allowing institutional investors to actually access and invest in those markets. And then obviously, you know, much harder is often attracting international investors into those markets. The second lens is really looking at some of the pool of securities that are actually available on those venues, and that's both in terms of the number and varieties of firms that are actually listing on the venue, but also the associated products that go alongside that, and how do you launch a successful derivatives market that can enhance the liquidity in the underlying securities? You know, how do you make sure that ETFs and fund structures are being brought to market that also enhance that liquidity? And there's a lot of interplay between those different asset classes that can benefit the overall liquidity story. And then finally, there's the actual sort of market environment itself, and there's sort of several flavors in that last bucket. One is the actual sort of market microstructure and setup itself, and that's pretty broad. That includes everything from the electronification of that market, making sure that the market is dematerialized, so depapering those markets, all the way through to some of the more advanced sort of technological innovations that you've seen in some of the developed markets, and those are often a double-edged sword, as we'll kind of get into later on in the presentation. And then there's a lot of work around just how you sort of make sure that there's a supportive regulatory environment, and I think certainly from my experience of working with exchanges across the world is that relationships with the regulators are absolutely essential in terms of helping develop liquidity, helping come up with proposals. Often an exchange simply working by itself can't overcome some of the hurdles that are stopping liquidity, and having that strong regulatory relationship to help provide that enabling market is absolutely essential. I think, although the writing is somewhat small, this is sort of the breakdown of the levers in sort of that first bucket, and really looking at how you diversify the investor base. And for those of you who have read the report, you'll see there's a lot more detail on each of these levers in that report. We try and give a sense of the kind of relative impact and kind of how easy some of those levers are to pull. And as we go through, we also talk about just kind of what stage of market is it sort of appropriate for each of those levers. And I'd caveat that by saying, as we've already heard today, no two capital markets are the same. Each has their own starting point in terms of the investor base, the mix of securities, the regulatory environment, the tax environment. So there's no right or wrong order to start pulling these different levers in terms of building liquidity. It's very much an exercise of evaluating the market, evaluating where you are, evaluating what the issues are, and then pulling the appropriate lever at the appropriate time. And the market stage gives an idea of where they may be most appropriate, but there's certainly no one size fits all. I think we go into the report a lot of detail about growing the retail investor base, and I think for some markets it's an incredibly important aspect of developing both liquidity, but also bringing opportunity to the general population and ensuring that they have a chance to sort of invest and partake in that capital accumulation, that capital growth. Now, obviously, the retail investor base, if done poorly, can obviously lead to some fairly significant issues in terms of markets. A good case study is in China back in 2015, where the high proportion of retail investors really contributed in a negative fashion to the volatility of that market. Almost on a daily basis, trading alarms were being issued, and that kind of exacerbated the issue. So with the retail investor base, it's definitely a difficult part to get right. Where we have seen examples of exchanges getting it right, a lot of the effort has been around investor education and really providing that base of knowledge and understanding in the market. There's also a lot of work to do just around understanding how the complicated network of intermediaries really sort of has to be interacted and engaged with for those retail investors to make the best use of those markets. And as I said, even in developed markets, that can often be quite a complicated structure to navigate through. And then we've seen some great examples of just simplifying market access to retail investors. And some of the best examples of the ability for someone on a mobile phone to interact with markets has actually come from developed markets exchanges, where they've developed genuine innovations in terms of allowing individuals access to those markets. Going hand in hand with that is looking at the local institutional investors. And here, almost in every market, there are regulatory barriers, particularly around kind of incentivizing some of the pension funds. And I know there's a session on that later on today, which I'm sure will highlight some of the issues that often pension funds find in terms of accessing markets, whether that be regulations around the holdings and investments they're allowed to hold, the capital rules that go alongside that as well. And there's also always tax incentives as well, and I think this is one of those key areas where exchanges need to work closely with their regulators to really understand where they're going to be able to sort of foster change in terms of some of those dynamics. And then finally, I think that the hardest one to get right is also attracting international investors. And here we talk about things like liberalizing the market, so bringing some of those regulations in line with some of the global norms. Once again, certain tax incentives and removing some of the barriers towards capital inflow. And then we've seen some really sort of innovative and dynamic sort of uses of building links to developed markets, where they've really managed to incentivize sort of flows from across borders into the markets. And I think we've heard a lot of good news this morning about the Casablanca Capital Market Initiative, which is obviously aiming to try and sort of emulate some of those things. And those, if done right, can be exceptionally powerful in terms of bringing in another source of diversified liquidity onto the venue. I'll hand over to Jean for some of the interesting case studies.
Right, so the first case study that we looked at was the Stock Exchange of Thailand and their experience with enhancing the retail investor base in their market. Just some facts and figures about Thailand, because it's useful for purposes of contextualization. As at the end of 2016, their market capitalization was about 430 billion, which I know sounds large, but is in fact about half of the Johannesburg Stock Exchange, so large but not enormous in emerging market size. 639 listed companies, which is fairly significant. Value of share trading full year about $329 billion, roughly 91 million trades over the course of 2016. Anyone want to guess what the turnover velocity was for, the liquidity was for Thailand last year? This is audience participation. Anybody guess? Throw out a number. 80%. Good guess. 80%. So significant liquidity in that market. 55% of value traded on the Thailand Stock Exchange comes from retail investors. Now, Asian exchanges, based on our data, typically have, firstly, much higher turnover velocity and much higher retail participation as a starting point. But that said, Thailand has, in fact, actively implemented measures over the last decade plus to enhance the depth and breadth of retail participation in their markets, and also to enhance the quality of the retail participation, which Quinton alluded to with the point around investor education. So some of the things that Thailand has done is they have addressed cost issues in relation to accessing market. They moved to fully negotiable broker fees in 2012, which has significantly brought down the costs of trading, and they saw quite a big pickup in trading after that. And in fact, the WFE is in the process, this year's emerging market research, of doing research around enhancing retail participation, and we find transaction costs is one of the main levers, either enhancing or restricting access to markets. So move to negotiable brokerage fees, engaged in extensive education. So they not only have many of the financial literacy programs that you will be familiar with, they also have an academy which trains brokers and investors about accessing the market, investment opportunities. They also have a program with their listed companies where they encourage companies that come to market to set up a provident fund for the employees of the company, and then engage in education with the members of the employees of the company to talk to them about their investment options and how they might think about managing appropriately the risk profile given where they are in their retirement cycle. They've also addressed access. So Quinton made the point about enhancing access is obviously a big driver. So the exchange itself has developed an online mechanism which it makes available to its brokers to provide to their clients that give them direct access to the market through their cell phones, online accounts, etc. And they have also, trying to think of the many other things they've done, they've introduced the banker to broker program where they actually use the banking network, which is in fact, as we all know, much more distributed than the broker network in many markets, where people can actually open a securities account by going into their local bank, not necessarily having to go into the brokerage. So they've extended their network into the banker network as well. So that talks to that. Oh, sorry, no, I've gone too far. I keep going too far. We keep going too far. Can we go back one? Is it possible? No? Okay. The other slide, which is lovely, but I've just flipped over it, talks about the linkages, linking developed and emerging markets, which Quintin also spoke about. And the example we used, the case study we looked at here, was in fact the Hong Kong-Shanghai Stock Connect program. Now, it is admittedly connecting two initially very large markets to begin with. But what is noteworthy about it is that it connects an emerging market, and actually China is not yet qualified as an emerging market, so a frontier market with a developed market. It's a two-way linkage. It enables investors in both China and in Hong Kong to connect using their local broker and trade on the other market. And since the launch of Shanghai Hong Kong Stock Connect, that was in 2014, they've since extended that. They've now introduced Hong Kong Shenzhen Stock Connect, so connected the other major market in China. And they have just recently, it was in the last few days, announced a Bond Connect program that will link the bond markets between those two countries as well. There are a number of structural issues which we go into in the paper, so I won't go into them here, which perhaps have limited the flow of activity so that it has perhaps not reached the volumes that people had anticipated. But that said, I looked at the sort of comparative stats yesterday. The flow from Hong Kong to China now contributes to about 1% of the daily activity on the Shanghai market. That sounds low, but the trading activity on the Shanghai market is enormous. And the flow, interestingly, from Shanghai onto the Hong Kong market accounts for about 20% of the daily volume on the Hong Kong market. So despite the fact that the volumes are often below the quotas that are set for daily activity, they are still seeing a significant contribution to overall activity on those markets as a consequence of this.
Perfect, thanks, Siobhan. I mean, the second group we look at is really looking at how to increase that pool of securities on financial markets. And I think we spent a lot of time in the report talking about how you solve the problem of attracting more domestic issuance. And this is often, once again, a kind of multifaceted problem in terms of attracting those firms. A lot of those firms, looking for funding, often have very good relationships with banks, very little experience with equity, very little understanding of how equity markets work. A fear of losing control of a firm, particularly in markets where they're predominantly dominated by family-owned firms. And as I said, it's very alien to them to come to an equity market and to try and raise capital. There's a big gulf in terms of their understanding of exactly how it's going to work, and also fear of just how painful it's going to be to go through both the initial IPO process, but also the ongoing disclosure requirements for that firm as well. There's been lots of efforts to try and increase that flow of firms coming onto markets and going through the IPO process. Whether that's increasing the sort of listings value proposition, so exchanges actually beginning to look at how they can provide a better listing service, providing better links, better education, etc. There's a lot of work to be done around making sure you get the admission or listing criteria right. And I'd say here, once again, there's always a balance in terms of those criteria. Often you see sort of talk about the two extremes in terms of either a merit-based approach, whereby the regulator often sort of review the firm and then make a decision on whether that firm is appropriate to be listed. And at the other end of the spectrum, a more disclosure-based approach, where obviously there's specified rules that have to be fulfilled in terms of satisfying the market participants that company is, investable. But within that, there's a whole spectrum of, adjusting those admission criteria to make sure that they're right and appropriate for that market. And obviously, there's a balance to get right between making them, tough enough such that investors have confidence in terms of the stocks they're investing in, but not making them overly burdensome on the companies that are actually trying to list. And finally, in the more advanced markets where they're really targeting some international investors, there's a big push to align those listing requirements with international standards. And for any international investor, that's almost a prerequisite for them being able to invest in that country. So often they'll have many rules and requirements internally that govern what they're allowed to invest in. And often that international standard becomes a fairly sort of key roadblock in terms of them being able to invest in those companies. Sitting side by side of that domestic issuance point, as I mentioned earlier, there's a range of alternative asset classes, and often the links between these and the liquidity in the underlying securities isn't immediately obvious. I think the easiest one to think about is in the derivative space, whereby promoting single stock or index futures and options has an immediate benefit in terms of the individual investors, giving them the ability to manage their risk and manage their exposure to those companies, ends up enhancing the liquidity on the underlying venue as well. Sitting side by side with that is a lot of activity around the ETF space, and obviously over the last 10 years ETFs have dramatically increased in terms of popularity. It's now come a go-to investment vehicle for many investors that seek to move from active to passive management, and they're particularly popular in terms of allowing people access to developed markets where they don't necessarily have the time or the information to gauge investments in individual firms. So those ETFs allow them with a very easy vehicle to start accessing and investing in those countries. And then finally, we've seen a few examples of really genuine regional marketplaces. I think one of the first in the world was actually in Europe, where Euronext managed to successfully link up for individual capital markets, so across Paris, Amsterdam, Brussels, and Lisbon in Portugal. And to do that was actually a sort of multi-year process for Euronext. And they genuinely created a regional marketplace across those 4 regions, going through the process with each of those 4 different sets of regulators to align listing requirements, align execution requirements. A lot of this before the days when MiFID really got going, which was the big block of European regulation. There's a lot of benefits to doing that, to creating a harmonized block of regulatory standards where there's a large block of countries collaborating together. That's very attractive for international investors in terms of being able to access a group of regions, each with different dynamics. It helps with the diversification benefit as well in terms of those investment portfolios, etc. It's not a particularly easy one to do. A lot of the levers we talk about today require collaboration, and this is one of the ones where collaboration is absolutely key. And then we've got a couple of case studies as well, I think. Hopefully we'll master the clicker. Damn.
All right. So the first thing we want to talk about is not, in fact, this slide. It's on the previous slide. Is the experience of the Brazilian market with their listing of companies and the use of disclosure and governance standards on their market. At the end of the 1990s, the Brazilian market was in fact in very bad shape. They, in the period between 1995 to 2000, had only 8 IPOs in that 5-year period. A number of companies were in the process of delisting from the market, and any new companies that were coming to market, Brazilian companies, were choosing either to list on the predominantly New York Stock Exchange, or to the extent that they listed on the local market, they were also listed on the New York Stock Exchange, and most of the trading activity, in fact, happened there. The Brazilian exchange identified essentially 2 sources of the problem there. The one was really a corporate governance problem, and the other was a transparency problem. So on the corporate governance side, many of the companies that came to market, in fact the majority, issued non-voting preference shares. So the control of the company was held by a minority, and minority shareholders in the company were often found themselves in situations where the decisions were taken and they didn't have any say over what happened. There was also, because of lack of transparency and concerns around corporate governance, at least a perception of high risk and certainly high incidence of fraud in those markets. There had been some legislative attempt to try and deal with this, but it had been largely unsuccessful. So the stock exchange, talking to Quinton's point about what the exchange can or can't do given a particular environment, the stock exchange decided that they weren't going to preclude companies from listing, but they would introduce a tiered listing model, which encouraged companies to adopt higher standards of corporate governance and minority shareholder protection. Companies could still opt to list on the lower tier of the market if they wished to, but there were subsequent tiers leading eventually to what was called the Novo Mercado, or the new market, which required companies to adopt more what would be thought of as best practice corporate governance standards. Since the introduction of this new governance standard and practices, more and more companies have opted to comply with these higher requirements, in part because they saw they were getting more liquidity and higher valuations as a consequence of this compliance. And the last time I was in Brazil, which was about 2 years ago, the exchange told me that almost no company opts to list in the lower tier anymore. Every company opts to comply with the higher tier listings requirements. So that's an example of how even in markets where perhaps the exchange is reluctant to impose too many government standards, given that for companies it is a new thing to use equity markets, they can encourage a transition to higher governance and then actually demonstrate the business case and the value proposition for exchanges, for companies of complying with these higher governance standards. This example here looks at the National Stock Exchange of India and their experience with derivatives. So the NSE launched their derivatives markets in 2000. We show the data from 2005. And you can see what's happened to the NSE's derivatives market over that time. When they first launched, and even back in 2005, they were a relatively inconsequential derivatives market in global terms. At the end of 2015, they were the world's #1 market in stock index options. Interestingly, though, what was particularly interesting in this case study for us was the points they made about their experience with growing their derivatives market. The exchange actually launched with stock index futures. That was the product they came to market with. Over time, however, they have discovered, and it's emerged, that the most actively traded contracts, the one where there's the most demand in the market, are now stock index options, and currency futures, a relatively new product for them, growing significantly in activity. The main point that they made, and there were two main points. The first was that education was absolutely crucial, market education, when they first launched this market. They said it wasn't, they assumed perhaps that they could just, derivatives were relatively well understood products, they could launch the product and people would get it and start trading it. And then they discovered, in fact, this wasn't the case. They had to engage in extensive education around what is a derivatives product, how does it work. This was not just with market participants, but in fact with the regulators as well. Regulators are often, if they're new to derivatives, very uncomfortable with the products. Everyone has unfortunately heard Warren Buffett's claim that derivatives are weapons of mass destruction, and so there is a certain reluctance with regulators to engage with these products. So education remains critical. The second point they made was that education is critical for every new derivatives product launch. You cannot simply assume because you've had a derivatives product before that the market gets it and they can simply continue to roll out the new product. What they did point out, though, was that the education cycle shortens as the market becomes more familiar. So whilst it took, they said, roughly 4 years for them to get the first product well understood, widely used and accepted, when they launched currency derivatives, within about 8 months they got to the level that they'd previously taken 4 years to get to. And the other point they had was that, final point, second point, was that you sometimes had to go back to the drawing book with product design. So in one instance, their index derivative product, they launched the product, and after a few months of the product being used, being out in the marketplace, being used by market players, they discovered, in fact, that the product design created certain problems in terms of usage. So they've gone back to the drawing book in terms of the design of the product and have had to relaunched it and started the re-education process all over again. Sorry. It's different order. Again. All right, and then the final one, we've got a session this afternoon, either this afternoon, I think it's tomorrow, in fact, on regional integration. So I'd be very interested to see how this experience coordinates with that one. This is the experience of the so-called MILA markets, which is Peru, Colombia, Chile, and recently Mexico, and their attempts at integrating those markets in Latin America. Part of the problem in Latin America is that, part of the reality in Latin America is that the Brazilian exchange dominates the continent in terms of size, activity, etc. So in order to counter this in a certain way and pull more activity into their market, originally the three markets of Colombia, Peru, and Chile, and then eventually Mexico, joined together to establish the MILA market. This combination makes them the largest market on the continent in terms of market capitalization, which obviously they wouldn't be as individual markets. Essentially what they've done is they've enabled the buying and selling of securities across the markets in the region through a local broker. That's somewhat of a misidentification because it's through a local broker in the one market who then connects with a local broker in the other market who then connects onto the exchange. And I think we all understand the reasons why the model would have been set up in that way. Whilst there has been some uptick in activity in periods, the sense that the participants have is that it's not at the level that they perhaps would have anticipated when they set up the regional integration in the first instance. This has not led them, however, to abandon the project. It's a bit like the EU Common Currency project. What they have decided is that what they need is tighter integration in order to achieve the benefits more effectively. So what they are focusing now is further integration and harmonization of regulatory standards and approaches across the markets, harmonization of tax laws. They've got differences in tax treatments across the markets, attempting to facilitate access so that you no longer have to go directly through a local market broker. You can access simply through your broker, which would cut out some of the cost elements that may be an impediment, and looking at the barriers to institutional investment across borders, because one of the big challenges in this framework at the moment is that institutional investors are still restricted in their ability to access across the border. At the moment, they're working on the ability of institutions to issue bonds. So if they issue a bond in one market, it's automatically available for investment across all the markets, and similarly on the listing side.
I think we've just about mastered the clicker now as well. So the final lens we look at in the report is really how you sort of create that enabling market environment. And I think we spent a lot of time in the report looking at, what can you do in terms of the underlying sort of trading technology? And there's a really sort of, broad spectrum that we saw, both in terms of the member exchanges of the working group on the report, in terms of where they were on this spectrum of sort of technological advancement in their market. Some of the earliest levers are often the most powerful in this case as well. So really just kind of creating a genuine sort of electronic market for trading, dematerializing, and that's dematerializing, front to back across the process, and ultimately with the aim of sort of reducing the settlement cycle as well. So, taking paper, taking, process out of that to help smooth the efficiency of the markets. Then you get into some of the more flavoursome technological advancements, and I think there's a caveat around a lot of these, whereby many exchanges have approached some of these sort of technological tools as additional revenue streams. Co-location is an excellent example of where exchanges have seen this as a almost free additional revenue stream. My caveat with all of these additional enhancements, whether it be direct market access, allowing algorithmic execution, co-location services, or even sort of greater support for some of the algo trading firms, is that you're fundamentally changing the makeup of people who are providing liquidity, who are trading on that venue. I don't want to get into a debate about whether high frequency trading is good or bad. We could debate that for the entire day and not reach a good conclusion. There's obviously value in terms of providing more orders to the order book, but they fundamentally alter the liquidity, the type of liquidity that's being provided, and that needs to be taken hand in hand with providing some of these advancements. But ultimately, they can sort of provide a liquidity bump if done well. I think there's another block of sort of enhancement that can be done around market data, and often this is an area which is overlooked, but actually relatively easy to address in the early stages. And that's just making sure that at the very basic level, there's the right provision of both real-time data and historical data, something that almost everyone in this room will be familiar with. And there's the level beyond that, which is looking at some of well, what are the additional analytics and tools that I can provide to the market using my own data. Either building that in-house or a lot of exchanges have gone down the route of collaborating with some of the larger data firms to provide some deeper analytics, some enhanced tools. And in many cases, that's been also working with some of the regulators to provide more analytics around the firms that are listing there. So working with things like in the UK, we have something called Companies House, which collects all the data on public firms. A lot of that data can be used by stock exchange and provide additional analytics, etc. And the other lever there is looking at some of the index capabilities, and obviously indices have become fundamental to many markets as well, and many exchanges now collaborating with various sort of index providers to have indices that are appropriate for their market, that allow people greater insight, allow them to benchmark funds, etc. One of the most prized assets in the London Stock Exchange of recent years has been the FTSE and Russell indices business, which have done phenomenally well. The last two levers there, market maker schemes. Once again, I think this is it's one of my favorite areas to do projects on, just because it's so wonderfully complicated in terms of getting market maker schemes right. There's various ways you can provide market maker schemes, various ways of structuring the rebates. Very powerful when done right, and can be potentially disruptive if done incorrectly. And in fact, on many developed market exchanges, when we do kind of reviews of their market maker schemes, often they find that the way they've set up those market schemes, 5, 10, 15 years ago, are actually not providing any genuine liquidity benefits in certain market conditions now. So they're hard to get right, but if they are implemented correctly, can be phenomenally powerful in terms of providing liquidity. And the more advanced side, and this is one where regulatory cooperation is absolutely essential, is looking at how can I introduce sort of short selling and securities lending and borrowing into that, and that obviously helps a group of market participants in terms of their market appetite. It often involves collaboration not just with the regulator, as I mentioned, but also with some of those firms providing those services, often the local banking firms. And they really need to understand the risks involved with taking on those positions and providing those services. And that can often be a multi-group effort in terms of providing those, but often very powerful in terms of enhancing liquidity.
So the last two case studies we look at are essentially what we call the electronification of markets, which is the initial introduction of electronic trading platforms and then the subsequent introduction of further enablement of electronic access to markets. So the Brazilians moved to an electronic trading environment in 2005. That's when they closed their trading floor. And since that time, they have introduced faster and faster iterations of their trading engine. So in 2007, the average round-trip latency on equities trade on the existing system at that point in time was 450 milliseconds. And the latest trading system, which was implemented in 2013, they're down to less than a millisecond. Now, these are obviously, these become more relevant once your market is more open to international investors, when you have the presence of algorithmic traders in your market, and when latency, this kind of latency, becomes a serious issue. As a starting point, however, the introduction of an electronic market that facilitates broader access into the marketplace is a logical point to start. National Stock Exchange of India was perhaps an early mover to algorithmic trading. The regulator there permitted expressly algorithmic trading from 2003. The exchange introduced direct market access in 2008, and smart order routing was introduced in 2011. So they have focused very extensively, given that they are a high turnover, high velocity market with lots of algorithmic trading happening, very explicitly on introducing latency, low latency access, etc., into their marketplace.
I've clearly not mastered the clicker. The last slide we had was really looking at, how do you go about evaluating, all of these levers? We've obviously run through a number of case studies, a number of levers. And just to come back to one of the points I made at the start, that there is no silver bullet, there's no right order to pull those levers in to enhance liquidity. One of the nice things about writing the report was the realization was that you can't do X, then Y, and then Z, and then bam, liquidity will appear. It's just too complicated. And every market starts from their own unique position in terms of investor composition, in terms of where they are technologically, where their regulators are, the market structure as well, whether they're mutualized or demutualized. So really it's about understanding, well, how is my market operating and functioning at the moment? What are the requirements from my investors and from my issuers? And what tools and what relationships do I have available that will enable me to pull some of these levers or not pull some of these levers? And then sort of taking a very structured approach to that. And I think in some of the case studies you'll have seen that often, enacting a change, doesn't immediately bring benefit, and it's often hard to disentangle kind of cause and effect from those. It's certainly never as simple as one lever immediately increases liquidity by 10%. It's an evolution over time of that liquidity profile, and often, it's education both in terms of the issuers and investors who are getting used to those new tools, those new products. They're learning how to use them, and in that NSE example in the derivatives market, as Siobhan said, that took many years to build up that confidence in those products, both from the individuals using those products, but also the regulator in terms of having confidence that these weren't instruments of mass financial destruction. So it's very much an evolutionary process. It's one that requires evaluation of where the market is. It's one that requires collaboration. It is a road which is well traveled, and there's many different routes, but it's a very interesting journey, and I think an essential one. And I think, coming back to what we said at the start, the benefits of liquidity are so multifaceted, and fundamentally help drive the underlying economic growth. And I think, everyone in this room, whatever conversations they're in, everyone that I've met that works at a stock exchange or at a regulator is unbelievably passionate about driving growth in their own financial market, and ultimately that's the tool that that's what liquidity provides. It's that lubrication that helps build that financial market.
So, are there any questions or observations from the floor? Whilst you have us.
We've got time for 2 questions. So, anybody's got questions from the floor for me for our own liquidity event?
Yes, please.
Could you introduce yourself when you're asking the question? We've got a roving microphone.
Thank you. I am Joyce Dlamini from the Swaziland Stock Exchange. May I first start by thanking you, Siobhan and Quentin, for your presentation. It was really resourceful. My question is, you mentioned the case study of, I think it's the Brazilian market, where you talked about the banker to broker programs. May I ask how that works? Because we don't have such in my market.
So essentially what it does, and I'm happy to actually get more information across to you, but essentially what it does is it enables people to go into a branch of their local bank and open a brokerage account in the bank rather than having to go directly to a brokerage. So essentially what it enables is an extension of the brokerage network through the banking network. And I can get you more information on the details, the detailed mechanism of exactly how that works. But essentially what it does is just create, it's a bit like being able to go to the post office and renew your car license in the post office rather than having to go to the DMV directly to do it. It becomes a mechanism to collect all the information, to do the KYC and AML checks that are required, and then feed that through to the broker to have the ability to trade started.
Another question here.
Hi, I'm Hassan Doudi from the Somali Stock Exchange. My question is a common one, really. So what I wanted to ask basically was, has there been any studies done in African exchanges in comparison to what you've done in Latin America and the Asia market? And from your observation, how do you think can Africa benefit from the findings that you've already found in these reports? Thank you.
I think in the report there's a couple of good examples around African exchange. I think we talk about the Egyptian exchange as well. I think I come back to sort of my Nigeria as well. I come back to my original hypothesis that all of these case studies are great. They provide you with a really useful, and I think the kind of comments that Siobhan makes in terms of, well, what did those exchanges learn during that process? For example, just how long it takes to educate, the fact that you've got to re-educate for new financial products. It's those kind of learnings that are really the best takeaways from these. You're not going to be able to take a particular region and exactly mimic their markets. And in fact, I think where I see real innovation in Africa is where they've not followed the traditional route. If you look at mobile payments, that's somewhere where Africa has really led the way. They've had a a unique problem, you know, a unique infrastructure starting point, unique difficulties, and rather than saying, well, you know, what's worked in the developed market, I'll just deploy it here, they've thrown that out and said, well, you know, what solution is going to work for me? And I think in this case, you've almost got to take the same approach and say, look, I've got all these levers, I've seen what these other exchanges do, and I know about their learnings, but you know, what are my problems and what are the tools that I have, and what solutions can I deploy? So it's difficult, but can be quite innovative.
And specifically on regional integration, I think there have been, I think someone actually presented a case study on the BRVM experience last year, and how that's worked, and we've got a whole session, I think, tomorrow on specifically African regional integration initiatives. You know, regional integration for me is one of those things where on paper, it's exactly the right thing to do, but it's very complicated to get right for all sorts of reasons. There are a number of moving parts. But that said, I think we might be getting to a point of sufficient understanding of what the moving parts are that we need to get right, that we might start to see some of those success stories coming out.
Okay, one last question at the back.
Yeah, okay. I'll present myself. My name is Mohammed Ahnouch. I'm an Associate Director at ABS, Africa Business School, based here in Morocco. I have two questions. First of all, thank you for your insights and for the talk. When we talk about liquidity, liquidity is linked to counterparty risk. And would have been interested to hear a little bit more about the situation of CCPs here in Africa. I know that there is one at JSE, at Johannesburg Stock Exchange, and CCP is also, having a CCPs would also enhance liquidity and reduce the counterparty risk. I would like to hear your opinion on that. And the second point, regarding the repo market. Regarding the repo market, is also, I've heard during the talk you mentioned lending securities. The repo market in Africa is mostly vertical between central banks and the banks. We don't have a horizontal repo market. Can you give much details regarding that? And thank you so much.
The CCPs are the central clearing counterparty.
So I mean, I think on the CCP point, you know, you're exactly right. There is a link between, you know, activity in the underlying market and the provision of clearing. It's obviously become a big talking point in developed markets around, you know, particularly mandates for clearing of more complicated financial products. I think a really good case study is one that Olive Wyman recently published a report on, hand in hand with the EBRD, so the European Bank for Reconstruction and Development, which really looked at regional CCPs in Eastern Europe. And obviously there, you know, equity clearing isn't the norm, but there's a genuine business case we made for how equity clearing can actually enhance the number of people who can access equity markets. It lowers some of the bank financing costs in terms of the capital provision for those equity trades, and actually help start enhancing some of the you know, other required enhancements that those markets need. That's a very good report and goes into a lot more depth around that, but there's certainly a business case we made for you know, clearing in terms of equity markets, and it's almost essential for the more complicated financial products as well. And we're ending up in a situation where firms are becoming a lot more comfortable and regulators are becoming more comfortable with cross-border clearing. I'll obviously remove any mention of Euro clearing and Brexit because that's a whole other kettle of fish. But generally speaking, you know, the idea of cross-border clearing where individual clearing houses have got expertise and using those across borders is becoming the norm. You know, Athex Clearing Greece also does clearing services for the Romanian market and the Cyprus market. You know, there's long-standing regions, you know, agreements between those countries, but that's a very good relationship and one where the regulators in those two countries have good communication, good confidence in terms of the clearing capabilities in the Greek market.
Yeah, and then on the repo side, I mean, so we didn't look at particularly debt repo specifically in our project, but certainly in South Africa, I mean, the South African government bond market is one of the largest and most liquid bond markets in the world, and it's predominantly as a consequence of the interbank repo market that exists to support that. So I would say absolutely, and perhaps even I would suggest that may be a more logical starting point for developing the financial market more broadly. Because the reality, I mean, we've spoken about stock exchanges specifically here, but the reality is stock exchange liquidity is largely reliant and dependent on the development of the financial sector more broadly. So developing at least a yield curve, a bond market that is active, where you have pricing going on, I think is a very important component to developing the stock exchange in that market as well.
So, thank you very much. I'm obviously the wrong person to be timekeeper because I find the subject so interesting, I don't want them to stop. And I really like the dynamic that we've actually got a room full of experts, so we're having very good interchanges up and down the room. But now we've got our own liquidity event, we've got a coffee break, so you've got 15 minutes, we're going to be back before 12, and we're going to push on. But thank you very, very much. Sorry, one last comment.
Just one last thing. This report is actually available to download off our website, so those of you who haven't seen it, you're welcome to download off the site. Thank you.
Yeah. So thank you very much to Yvonne Cleary and Clinton.